I'm Greg Hunter. Welcome to USAWatchdog.com. My next guest been on several times, and the last time she was on, she told us how she was invited by the World Bank, IMF, and the Federal Reserve to give a speech. And she was like, "Wow, I'm not going to say good things about what you're doing." And they said, "That's right. That's fine. Just come on and talk." So she did, and she basically told them if they raised interest rates at the Federal Reserve, they raised rates, they'd surely crash the economy. They have to do some one and done or whatever. What's the point? But she said you'd surely crash the economy. What they're doing has not been good for the economy. I'm talking about Nomi Prins. She is a best-selling author. This is her latest book, All the President's Bankers. And, of course, they must have listened to Miss Prins because they didn't raise interest rates. Nomi Prins, thanks for joining us today on USAWatchdog.com. So Thanks. They didn't raise rates. They must have listened to you.
Yeah, I think, well, A, that, and B, it's not so much crashing the economy as the markets, which is really what they're looking at. They're trying to balance this idea, particularly the Federal Reserve, that they're speaking of the right amount and right number of employed, inflation being contained, and so forth. And that's the language that they use when they talk in their speeches, when Janet Yellen speaks and so forth. The reality is they're very concerned about how the stock market and the volatility of the various markets between bonds and loans and stocks would behave if rates were to be raised. Now, let me step back and say, and what I said to them was the policy of having had zero interest rates and quantitative easing for 7 years has been an incredibly bad policy. They put themselves in a catch-22 of what they call monetary policy, which is in fact bank and market coddling policy, and there is no way out. It has not helped fortify economies on the ground, not in the United States, not in Europe, and increasingly not throughout the world, not in Latin America, not in Asia, not in Africa, and so forth. So this has not been a policy, even though it was spun to help the economy. It was a policy that helped the financial institutions, that helped financial asset bubbles, and that they have no plan B to unwind. As a result, had they raised rates, had the Fed started raising rates, it would have caused even greater volatility in the markets, greater uncertainty in the world, heightened economic stress in the countries that are matched to the dollar, which is already too strong relative to their currencies, and would have created just a larger mess than the mess they've already created in these past 7 years.
So when you say there's no way out, I mean, no way. So this happy talk about, well, we may raise rates in December, which is, I'm looking at that going, this is like Baghdad Bob talk. This is like, what? They hint at, we're going to do everything we can, exactly what Yellen said, but, they hint at basically more QE and negative interest rates, and then, but we may raise rates in December. That's a lie, right?
They are not going to raise rates in December. I didn't think they were going to raise rates in September. We talked about the fact that even if they would have, it would have been a 25 basis point token thing to act as if they have the ability to, but it would have been demonstrably bad in terms of volatility and a negative impact because they're in this situation where they actually don't have an out in that respect. And even so, you had the 14 biggest media analysts and mainstream business news saying all of them saying that rates were going to be raised. Of course, that didn't happen. It wouldn't have made sense to have happened. And it's not going to make any more sense to happen for the same reasons in December. In the next 3 months, economies throughout the world will not be repaired, markets will not be stable, currencies will not be stable, and all of a sudden interest rates will not have the need of the United States to rise as a result to hurt the other countries which are declining their rates and reducing their rates. So the Fed is not going to move in December. Now, Janet Yellen may want to at some point move. I think, she's received, and she's in the same mode as past Federal Reserve chairman like Ben Bernanke, like Alan Greenspan. She's received this situation of low rates. Maybe she had wanted to turn it around at some point, but the factors around the policy, around the economy, around the world, around markets don't lend themselves to doing that. And so she's in the catch-22 of her making, of the Federal Reserve's making, of the fact that the choice was made to bail out the financial institutions and pulp up the markets with artificial money and printing money and reducing the level of interest rates and reducing the level of currencies relative to the dollar throughout the world. That's the decision that was made. That decision has helped no actual individuals on the ground, but the talk is, we'll see what the economy does. We'll see if unemployment's better. We'll see if inflation's still low, and then maybe we'll think about it. That's all code for we're not going to think about it because we are scared to move and cause a worse situation than the one that we have already created.
Caterpillar out just late last week saying they're going to lay off 10,000. HP is up; they're going to lay off up to 30,000. Mig Whitman is like, "Whoa, we got too many employees. We bought too many companies." So, I mean, that's not good news. I mean, that's what you're talking about. How the Fed they're not going to no, they're not going to raise rates, and that's what we know now. So the news is not going to allow them to raise rates. That's what you're saying. That's what you're saying. No way.
The news that they pretend is the thing they most listen to will in itself not allow them to raise rates. In addition, what they really pay attention to, which is the liquidity in the financial community and the level of the stock market, which has obviously declined 2,000 points since the last time we spoke, Greg, just a few months ago, is also something that they are concerned about. They just don't talk about it publicly because technically it's not in their purview.
They have to hate you. I mean, you're a former big Wall Street banker, top Wall Street banker. You must get hate mail from certain segments of Wall Street saying, "What are you doing? What are you doing? Don't be blowing the whistle on what's a scam here that we've been helped out and everybody else has been screwed." I mean, that's what you're saying, basically.
Well, that's what has happened. I mean, and yes, that's what I'm saying. It's interesting though. A lot of people who actually manage money want to look at the facts and want to read the patterns and the signs of what's actually occurring versus what people are saying. And they know where this money, this fabricated money has gone. They know that the only reason the stock market even has risen or had risen to the record heights that it had in the wake of quantitative easing and zero interest rate policy started by the Fed and then proliferated throughout the world is because it enabled them to have cheap and easy money to inflate these bubbles, to cause more corporate debt to be raised, to cause more corporate loans to be extended, to do all the things that happen when the cost of money is cheap and now zero in this current iteration of the past 7 years. In the past, it was just cheap. Now it's zero. And that has created debt bubbles. That's created loan bubbles. That's created stock market bubbles. And they know this. And the banks at the core of this, right, they now have a situation where, for example, in the United States, they've continued to reserve their money at the Federal Reserve's account, and they get 0.25% interest rate in return. So not only are they getting money for free, whatever they do with it that they choose to reserve at the bank, at the Federal Reserve Bank, they're receiving interest for. So there's no reason for them to stop that game. And there's no reason for them to want the Fed to change rates. So that's really the situation that we're in. So I don't know so much as they hate me for pointing this out. I mean, I was on CNBC last week and I said that, you know, the conversation was whether or not it was a good time to buy bank stocks. And I said, well, no. Why would it be a good time to buy bank stocks? Because you've had 7 years of this policy, and now you have this heightened volatility. Now you have this heightened negativity. There's only so many so much of an amount you can inflate asset bubbles before they destruct, and that's what we're seeing now in the rising period of volatility over these last 6 months, this transition to destruction. And so no, banks are not secure entities, aside from the fact of all the crimes they have committed, aside from the fact that the big 6 banks in the United States have had to settle to pay $130 billion worth of fines in every single practice in which they engage, from foreign exchange rigging to LIBOR rigging to now credit default swap rigging, to everything they do to manipulate the markets because they are so big and therefore they can. That is continuing to unfold as well, even with all of this gift of free money. So whether they don't like me or not, I'm calling it like I see it.
So either way, this is going to blow up. We talked the last time that you said, well, if they raise rates, it blows up faster. And if they don't, it still blows up. So it still blows up, right? Aren't we, this transition to destruction is what you said. We have a transition to destruction. This is going to blow, right?
Right. And that's what I've said all this year, that we've had what happens before any kind of major implosion, and I've used that word as well, is the heightened volatility to the downside. And you and I have spoken about that the last couple of times. You get a heightened volatility to the downside, meaning a lot of jagged edges in the markets, particularly stock markets, because they most reflect the hot money going in and out. Currencies reflect it too. Currency trading reflects it too. FX trading reflects it too. That's why you have these rigging frauds going on, and I believe continuing to go on. As I said to the Fed a couple months ago, you should look into that because that's going to continue. But you have all these volatility points along the way in all of these different asset classes that heightens when the market turns down, and then it becomes a self-fulfilling situation. The more uncertainty is, the more every little tiny thing creates a more downward cycle rather than an upward bump. And that's what we're in right now.
Aren't these bonds no good? I mean, the bonds are no good. That quote, the asset that they're leveraging off of and then amping it up with the derivatives, aren't the bonds no good? What happens when the realization happens where all these bonds, sovereign and otherwise, are deemed unpayable, no good? What happens?
Well, already we've seen certain sovereigns have to readjust or looking at potential, debt situations. You've had Greece, you've had Argentina. There's been situations that have happened already. Puerto Rico on a sovereign basis, and you also have the fact that over the last few years, in particular in the countries that are least stable generally in terms of the financial community. You look at Latin America, you look at Mexico, you look at Brazil. These countries have really piled on additional debt, this time more in the corporate sphere. In sort of other debt bubbles, it's been a little bit more on the sovereign side. This time it's been on the corporate side because the money has been so cheap, particularly coming out of the U.S. and coming out of the European banks in terms of lending. It has been so cheap because rates are so zero. That there has been a pile on in the corporate sphere. So what happens is the higher yielding corporates, or what used to be higher yield, are now trading at high grade or very high quality spreads because they're getting money cheap. They are the first to blow. And then you have the higher grade corporates that are the next to blow because the spreads start to widen, and in particular in countries outside of the United States that have been denominated in dollars. When the dollar stays high, it's harder for them to pay dollar debt, dollar interest if it starts to go up with local currency profits because those profits are diminished. And that's another level of the cycle that starts to blow. So all of this is happening around the same time, and it's catalyzed by this volatility that's increased in the market and this sort of cycle of volatility and downward movement in the value of bonds, in the value of stocks.
Could we have a financial Mad Max scenario? I mean, where people just lose it all?
Well, I have been saying that is why people, like actual individuals, should be out of this situation right now to the extent they can be. And they should have gone into cash already in late spring and the middle of this year. And since which, of course, things have come a lot further down in terms of the markets, in terms of the values of their pensions and so forth. Because the problem is that if they were to keep their money in banks in cash,
You're talking about holding Benjamins and Hamiltons in your hand.
I'm talking about holding cash. I'm talking about paying down the things that you own. I'm talking about basically keeping a physical lock on what you have. Yes, you can keep some cash in banks and watch it. You won't get interest payments on your savings accounts or checking accounts anymore. That's been gone for the last 7 years. In fact, you are paying fees to the major banks in order for them to use your cash. So you're basically already at a negative interest rate. So sort of why keep it there? You need to keep it practically for paying bills and mortgages and so forth. So there has to be a minimum amount that you need to keep in order to do your own personal business practices. But beyond that, I believe that, and I have said that this is a good time to actually hold on to cash. And as this volatility increases, as there's a sort of lack of idea of which direction rates may or may not go, and whether I believe they're not going to be raised by the Fed, as I've said for a while. But the very question creates uncertainty in the markets, and it's uncertainty to the downside. So I think these periods are the best periods to be out, and being out is the thing that most protects individuals right now.
Gold took a pretty big pop on Friday. It's at 1150 land, which has been for a long time. I know it's manipulated. They say some people still say it's not, but it's ridiculous. Every market's manipulated. Forex is manipulated, and the gold market's manipulated. That's all there's to it. But gold took a pretty big pop, and it looks like some folks are running into gold. What do you think about that, running into gold, having some exposure to physical gold?
I've said and continue to say that sort of having a gradual exposure to some gold makes sense. However, the reason I say gradual and the reason I say some, meaning not to stick your whole portfolio and your whole future into gold in a big way right now, is because of this manipulation, not just of gold, not just of FX, not just of credit derivatives, not just of interest rates by the central banks that be, but by the combination of all of it. And that we're in this new world of finance where the markets are not propped by anything particularly real, where not only in the past did that unrealness used to be leveraged money, leveraged deposits, leveraged loans, and so forth, where you borrow against what you have, or you borrow against what you could get from the Fed as a large financial institution, on lend that, or on allow your bigger financial and corporate clients to use it in extension. Now you have all of the central bank money and then all the central bank manipulation of this entire process in the mix. As a result, the relationship, the past relationship, and this is important to note, it's different than it ever used to be between gold and, say, the value of the dollar, between gold and, say, the level of the classical measures of inflation. Right now, we have an inflated financial system. It is artificially inflated, and it's deflating in this volatile manner, and it will deflate further. But what we have right now is artificial, and so the measures, the classical measures of what inflation is, are not what they used to be. And so when you usually buy gold in a situation where you have inflation, and even if you have market inflation to an extent, you should buy gold because it's the natural hedge to inflation. It has a natural reverse relationship to the dollar and so forth. Right now, everything is so manipulated as a system. Gold hasn't behaved as it has in the past. Will it get there? Yes, but the system has to be sort of recalibrated back to some form of normalcy. And in those moments, gold will have that major bump. But right now, we're still not in normalcy. We're still in this transition away from what was normal to what will be, and we're in the 7th to 8th year of that transition. It's just getting very bumpy now very quickly because everyone is noticing, and every player in this market is scared, but still using and squeezing whatever they can, and whatever is left is in whatever it lasts in this fabricated financial system. And it's a system. That's why all these classical relationships are out of whack.
Pathway to destruction. It's imploding. It's destroying itself right now. That's what you're saying.
Right. It's in a transition.
Transition to destruction of destruction. Got it. I know you gave a speech in Latin America, and I kind of touched on this a little bit about how paying back in dollars is death to them. It makes their loans even more unpayable in South America. Are they going to go to negative interest rates? Are they going to go to more QE?
Here.
In America, yes, the Fed.
They're not going to call it QE. They'll probably call it something else. They might try to fund other currencies through their swap lines, their trading lines with other central banks, so they can start to manipulate currencies in that respect, and the relative level of interest rates and currencies as well. I think there's a real chance that they do something like that. So it doesn't look like bond buying per se. It's just another way still of infusing artificial money into the system, but just in another path. They tried to do that a little bit under the radar in the 2008 financial crisis element, but they didn't need to as much because there wasn't such a weird financial system recalibration as we've now had, having done this for the last 7 years of these policies. So therefore, they just went to buying bonds, and the ECB went to just buying bonds. So I believe if QE happens again, it will be a QE that relates to currencies and rates and swap lines, and it'll be sort of central bank to central bank, and from those central banks, then it will go into their financial systems in a slightly more stealth way. They might announce it, but it won't look the same as bond buying. But don't forget, the ECB is still buying bonds. It still has a program to buy bonds through the middle of next summer. So it's not like there aren't places that are doing that. The People's Bank of China is, of course, trying to figure out what to do over there, and they're infusing money into their system in different ways, and they're capping certain movements of money in certain ways. And their main problem was anyway that they allowed so much foreign speculation into their markets in November of last year, and that had a very quick impact of puffing their markets up on a stock basis. And now, of course, it's down by 40-45% because it wasn't sustainable. It was just hot money looking for a place to be. But that story doesn't get out as well. So all of these things, I think, will be part of whatever the new global QE looks like.
Well, what about negative interest rates? A lot of people are saying, wow, we might have they might be taking 0.5% of everything you deposit.
First of all, there are negative rates in Europe, and we have already, as I was saying, negative interest rates here. People are talking about sort of, will they get more negative? That's possible.
How are they negative right now? Because of all the fees and the the relevance of inflation?
If someone looks at their $1,000 savings account that they're getting dinged $20 a month to just physically have in one of the major banks, for which they're getting maybe a 1/10% maybe of interest, they are already at negative interest rates. They're already at significantly negative interest rates. So people already are. So the question is, will the Federal Reserve reduce rates below zero and make it look as if banks have to pay for money as opposed to getting it for free? It used to be for cheap, then now it's for free. Well, banks have to actually pay the Federal Reserve money. Maybe, but what it will look like is banks putting more reserves on the books of the Federal Reserve, which already has a book of $2.5 trillion worth of reserves from banks, and they will basically put those fees even more so onto individuals, onto smaller business loans, onto credit cards, and onto all the other things, just to get that little chunk back. So we may go there, and it will hurt us more in terms of the banks that we use, because they will simply raise all the fees that they need to raise from us in order to make up whatever they're not getting from the Fed. But it will be incremental here. The bigger issue is whether we also go to bail-ins if this transition to destruction results in a much greater crisis because of a lot of events throughout the world and a lot of negative confluence.
And you think the bail-ins are coming, that they'll actually be taking money? Oops, we're going to give you haircuts on your deposits because you're an unsecured creditor. People can't grasp that you're an unsecured creditor in a bank.
Exactly. How it would look. Again, first of all, let's just go back on what we just said. I'm giving money to you, a bank. You are charging me to give you that money. You are giving me a tiny little drop in return, but nothing related to what you are charging me. So that's where we're starting. So now, if there's a bigger emergency, and let's say the Fed's doing some sort of swap or foreign exchange QE, and the other banks are involved in that as well. Plus, they're continuing to do QE bond buying like the ECB and so forth. All this is going on. Now, all of a sudden, banks still need liquidity because, let's say, defaults start rising in loans. In foreign loans to corporations, in foreign bonds, in local loans in certain sectors like oil and so forth that have been lent to in a substantial manner. All that starts to happen. Where do banks go for money? They're already getting a ton from the Fed. Deutsche Bank and so forth is already getting a ton from the ECB in different manners. Now where do you go? You go to your depositors, because that's the next largest amount of potential liquidity that you can use in an emergency. And that's really what bail-ins are. For a regular depositor, when you sign up to be a depositor with a regular bank, it doesn't say right now that if there is an emergency, we will take part of your deposits. What you actually think is that there's an FDIC, which is there to secure you, since 1934, which is there to secure you in case the bank has a very large problem. The reality is the FDIC doesn't have enough money to secure all the trillions of dollars of deposits there are at banks anyway, in the event of a confluence of negative occurrences that could create another emergency, another crisis. So therefore, what happens? Maybe the FDIC only backs part of your deposit. That's kind of like a bail-in. Maybe the bank says, well, we're going to make sure that not only will you pay a fee to us for you giving us your money, but we're going to tell you that maybe a fraction of your money you might not get back. Maybe it will be 1/10 of your deposit. Maybe it will be 10% of your deposit. But there might be a fraction there in the future that we're just gonna hold on to. If you want to bank with us, you can choose not to bank with us. But if you want to bank with us, by the way, there's going to be a portion of this money in the event of an emergency you're going to fork over.
And you think it's going to get that bad, that bail-in, some form of bail-in, whether they call it one or not, you think that is coming? Bail-ins are coming.
I think some form is coming. I think that's the banking community right now, even with all of the generosity it has received. The larger banks I'm talking about, the smaller banks don't get quite the same generosity. Their cost is much higher for their money. But the larger banks that are involved in the policy decisions, that are involved in conversing on a regular basis with the heads of the Fed, the ECB, the IMF, and so forth, those individuals, those institutions want another security blanket. And that's why all of this conversation about, going to bail-ins, going to take away the idea of physical cash. All of that continues to play because they're simply looking for another out in case what they already have, which is pretty huge and epic and unprecedented, doesn't work at some point in the future. Right? And they have the ears. I mean, I might have some ears, individuals might have some ears, but the reality is, it's still the bigger CEOs of these institutions that have the relationships with the governments, that have the relationships with the largest central banks, that have themselves become part of this fabricated financial system. So now they're all listening to each other to try and find ways to make sure that all of what was done in the last 7 years, that again hasn't helped the actual real economy, but all of what was done to sustain the larger elements of the financial system and the markets and so forth isn't for nothing. And so that's why they're discussing all of these other various methods. And that's why I say it's a good idea to sort of, batten down the hatches with respect to your cash. I mean, if you're a trader, you can go short. I just don't suggest that to actual people. Because I think there's additional risks in that, and I think that holding what you have, or at least as much of it as you can, is still a good policy for people.
That's pretty good for the common person. Holding your own cash is kind of like a trader going short.
It kind of is.
Cool. Nomi Prins, thanks for coming on and giving us your update. Nice call on, they won't raise rates, they'll crash the markets. They listen to you. All the President's Bankers is Nomi's latest best-selling book. She's had 3. All the President's Bankers. It's out on paperback right now. I have a copy of the paperback version. I also have a hard copy, too, but it's out on paperback. Nomi Prins, All the President's Bankers. Nomi Prins, thank you for joining us today on USAWatchdog.com. Hope you come back.
Thank you. I will, Craig. Thanks.